I'm curious, do you think a 50-year mortgage is a good idea?
Well, there's been some folks that have been talking about this, but our current administration has been talking about the 50-year mortgages. So we're going to break that down for us today about whether that's good, bad, the pros, cons, all those kind of things. My name is Alan Richard. I'm the managing broker here at Maxwell and Realtor Partners.
My name is Bing Richardson, the compliance broker for Maximum One Realty and Realtor Partners.
And so we want to talk about mortgages in general and about the potential for a 50-year mortgage in specifics. But first, we kind of want to break it down in that there has been a lot of talk recently about a 50-year mortgage. And on the face of it, like I'm open minded to anything that will save buyers money,
Yeah.
that can make homes more affordable. I think affordability is definitely a big issue in our current market for sure.
And it's interesting. This Sunday, we just had a talk with one of our member church, and they're like, the houses are so crazy, we can't afford it, and what have you. So, like a realtor that we are, and also about building legacy for our friends and family. I explained to them. I said, your monthly mortgage rent will always go up, while your mortgage, if you have a home, will maintain the same.
So obviously, we're big proponents of home ownership, and we're big proponents, and we know that most people need to utilize a mortgage to do that. But not everybody understands how the mortgage market really works. So we want to kind of briefly explain a little bit about the mortgage market. So right now, a 30-year mortgage follows the 10-year Treasury. So if you were to lay out a 10-year Treasury and you were to lay out a 30-year mortgage on a graph, you'd see that they
They move
move
in sync.
in unison. They really do. Now, the driver, though, is the 10-year Treasury T bills, 10-year T bills. And those 10-year Treasuries are affected by things like the market, inflation, like the federal funds rate affects them also. Now, a lot of people have a hard time understanding the difference between the federal funds rate versus a 30-year mortgage or a 10-year Treasury. The federal funds rate, that's the rate at which banks can borrow money. And
From the
then,
federal government.
and so they're going to pass that along. And so you can't say that doesn't have an impact. But what really impacts it is the 10-year Treasury. So that federal funds rate is going to impact the 10-year Treasury. The markets are going to impact the 10-year Treasury, those kind of things. So, even the last two times when we had the Fed lower the federal funds rate, mortgage rates didn't move. They had moved already. They had moved in the weeks and months
Mm-hmm.
prior to. The market was already pricing in those
So
cuts.
mortgage company, what they do is that when they anticipate there is going to be a legitimate cut, they'll go ahead and reduce it 30 days in advance. Because if you think about it, we close in 30 days. So therefore, it behooves them to go ahead and get that bump started so the market can start react to it much quicker than waiting on the federal fund rate to drop.
Yeah,
But they only do that when they know it's like gambling. They only do that when they know for sure that it's going to drop.
yeah. Now, the in between the 10-year Treasury and the 30-year mortgage rates is this gap, and that is called the mortgage spread. And so the mortgage spread for years has run like 1.7% difference
Mm-hmm.
in there. It has really been much higher for the past several years. But the good news is we're seeing where that is tapering down. So we're down to like 2.25 now, just a little over 2%. So that's moving back into the normal range, I guess you'd say. That spread is highly deemed as being risk, right? That's the risk that the market is feeling between the 10-year Treasury and the 30-year mortgage rates. And so, for just like regular mortgages, right? I mean, Ming is a mortgage lender, so being able to understand how these things work is really important for real estate professionals in general, right? So, like understanding this can really help because even though we may not be the biggest fans of a 50-year mortgage, and we'll explain why in a
We'll
minute.
show you some information that may shock you.
Yeah, we want you to see that right now mortgages are looking like
Really
a
good.
lot better, right? I mean, we are seeing where the spread is tightening. We've seen where, like right now, For conventional loans, where are those coming in at right now, Megan?
Conventional is running about little around about 6.25,
Hmm.
and right now we just wrote one for 61.25 for FHA. So it's looking really good. And honestly, what some of the information out there is that it's not always the rate that makes such a huge impact. If you think about, it's about the value of the home. The home has risen so much more after pandemic than before. So you're actually buying more dollars, even though the interest rate is right where we were before. And it's about monthly payment and what you can afford.
Right. I mean, because real estate has appreciated at 4.4% a year for the last 50 plus years. Now, we may not be seeing the same level of appreciation right this minute, but we were seeing double that,
Correct.
like right after COVID or right during COVID even. So overall, we're seeing where right now your most, a lot of your conventional loans are coming in the low sixes. We're seeing govies, FHAs and VAs coming in really close to six and even under six in some instances. And while I know that there's a lot of people who say, "Well, yeah, but that's not three. That's not 3%. I want to wait
Three
till."
percent is not going to happen again, y'all, because the federal government was loaning the bank at 0% interest.
And at the same
No
time,
way
they
that's
were
going.
buying mortgage backed securities. And what that means, and a lot of people don't understand mortgage backed securities. So, all these mortgage companies, they buy or they fund all
Mm-hmm.
these mortgages,
Correct.
right? And they'll put them into bundles of hundreds and 200s and 300s and thousands of mortgages, and they're all rated together. And they're put in this big bundle. And then those are sold on the secondary mortgage market. There's this other mortgage market that real people don't see because the dollars are in billions and it's really big. Insurance companies, things like that, really work on the secondary mortgage market. And the reason that it's important to understand that is those people on the secondary mortgage market, they're buying risk. They're buying how likely is someone to pay off this loan. And see, that's where you start getting into some of the big challenges for a 50-year mortgage. And we'll explain more about that in just a second. But we just want you to understand that there's this whole other world out there that really does affect mortgages. And understanding how that works can really help you understand what we're talking about overall, especially when it comes to the 50-year mortgage. Now, overall mortgage rates for the year,
Look at the graph.
I
It
mean, like
looks great.
we have it has been so much better than it was, and honestly, we've been on a pretty interesting
Roller
ride.
coaster.
Yeah, I mean, like I remember when rates were at the threes and fours, and then all of a sudden the rates went to five, and everyone lost their mind, right? Like no one's gonna buy a house at 5%.
We're gonna wait until it drop back to three.
Yeah,
You guys, like I said, that is such a unicorn, and the administration was trying to stimulate the economy because right at pandemic, the housing market took a dive because nobody wants to show their house because the virus, and nobody wants to put a house on the market because of virus. And the folks that did, it was very cautious and very systematic to where to prevent that virus being spread because there was such a huge fear on COVID, and there were people dying because of it. And that's why the housing market took a dive during that time. And that's what
but then it turned
the
right around and
administration,
shot back up.
right, that's what administration did to promote um, that stimulus money moving and flowing.
Right. But those 3% rates were artificial, right?
Hmm.
In the secondary mortgage market, the Fed was buying mortgage backed securities. We had 0%. I mean, banks could borrow money at 0% interest.
0%.
So there was a lot of incentives. That's not going on now. We're not, like if anything, the Fed is selling off those assets that they bought during those times still. So we're seeing where if you were saying, I'm going to wait till the rates hit four, I'm going to wait till the rates hit three, then realize that you're never going to own a home. You will not own a home then. And granted, this is my humble opinion, but I'm just telling you,
I mean,
you're not going to buy a house,
that
right?
unicorn can come appear again,
Yep.
but likelihood of that, it has to be something dramatic,
Yep.
something of extreme
Yep.
circumstances.
but the mortgage rates are trending down, and the good news is I mean, a year ago we were over in the eights, right? I mean, it was low eights, but still, that's a
It
pretty
was 8.
significant drop, right, for that. So, um, let's talk about how all this applies now to a 50-year mortgage, and
Well,
so.
the thought was behind that was to lower the monthly payment,
And
so
I
it
get it.
make
I
the
like
home
the thought. It's a
affordable.
good thought. Like anything that like I'm not opposed to the thought, but not a lot of reality has kicked in, right?
Well, if you think about when we show you the number, you'll see why we feel like that additional saving or less payment monthly is going to cost the homeowner a lot more in the long run.
Well, first of all, a 50-year mortgage would be considered a
A non qualified.
non-qualified mortgage. And that means that's going to be a specialty type of product, which means that Fannie and Freddie would not underwrite it, would not guarantee it. And that in and of itself means that those interest rates are going to go up. The other thing going on is with a 50-year loan, it takes a lot more time to build equity. I mean, even think about a 30-year mortgage rate. Your first few years on a 30-year mortgage rate,
Strictly
you're
interest.
paying almost interest. Now on a 50-year mortgage rate, I mean a 50-year loan, you're paying it for years only interest. So it's going to take a lot more time to build ownership versus paying off your interest, right? One other thing, just to kind of throw it out there aren't really any 50-year mortgages out there. Now, there's some mortgage
There's
companies
some talk
that are
about
looking
50
into a
year,
50 and a 40, right?
right? But there's
So,
non existing. Well, if it is, it'll be what they consider a non qualified mortgage. And so just give you some idea. Okay. If you're buying a $400,000 home with 6.25 interest rate and 10% down, as an example,
yep,
okay, what you in a 50-year mortgage term, guess how much does that save you?
your monthly payment is about 250 bucks less.
You guys, if it was me, and I'm not saying this is a good fit for everybody, and some people may choose that path. I don't know, but I'd rather not go out eat twice, 3 times maybe a month, and cut that out, or not do the Starbucks, not do
Yep.
something because additional 20-year in the same mortgages when you can have full equity is huge.
Well, I mean, here's the deal, right? If you go and you were in I realize we're talking about unicorns here, right?
Yes.
But if you went and had a 50-year mortgage on a $400,000 purchase price, that meant that your monthly payment is $1,961. Now, on a 30-year mortgage rate, that's $2,216. So we're not talking like,
A
oh my
huge
gosh,
difference.
right? So, but there is a huge difference between interest, right? So on a 30-year mortgage, now when you buy a house, except that like with a traditional 30-year mortgage rate, you're basically buying the house twice. Well, when you buy it on a 50-year mortgage rate, you're buying the house three times. So
So
on a 30-year loan, how much interest do you have to pay on a 30-year loan?
total of 437,000 plus your original purchase
Yeah.
price.
How about on a 50-year mortgage?
817,000 plus your original purchase price. And granted, we know over 50 years a house going to appreciate,
Yeah.
okay? I get that all
But
day.
still, that means that the 50-year
But
mortgage, you paid $1,200,000 for a
$200
$400,000 house,
for
right?
less than $250 a month, you're extending this loan for an additional 20 years. For me, it does not make sense. And this is where, for some people, it may be a good fit originally, but I just want to make sure you educate your client because real estate is about wealth building, it's about creating your legacy. This to me is really not because if you think about average buyer doesn't buy until their late 30s. While 50-year mortgage, guess how old they will be? Yeah.
Yeah.
So
I mean, like on a 50-year mortgage, it's roughly $380,000 more in lifetime interest payments versus a
that is just
30-year mortgage,
interest.
right? And while on one hand, I do believe that, and we see it right now, we see it absolutely that our buyers are buying on price on payment, not
Correct.
on price, right? They're buying on what they can afford. And so I get that. But my worry is that it's very easy to say, oh, well, I can lower my payment by $250 and not realize what that really costs you long term, right? So, like, overall, your equity growth is 4 times slower, right? It takes 4 times as long to build any equity. So, like, you're talking like, oh, I mean, whereas for a regular 30-year mortgage, if you're not going to be there 3 or 4 years, you really shouldn't buy, right? Well, on a 50-year mortgage, if you're not going to be there 15 years, you shouldn't buy,
And
right?
that's the difference
I mean,
between the
yeah,
30 and 50
the interest
years.
paid and like almost your entire early payments are all only going
Interest.
towards interest. And so we love the idea of being able to lower a borrower's or a purchaser's over, I mean, monthly payment,
It
but
once
not at the
again,
expense of
yeah.
having to
Well,
cost them.
we want our clients out there. I mean, our clients are our fans, right? This is what we do for a living. This is what we do to protect the public
And
interest.
we care about
And
them.
we do want you to know the difference between 30 and 50. Now, with that said, I just want to let you know you can always refi 6 months after you made your first payment. So while this may help someone
Still have to
initially,
qualify, right?
okay,
Yeah.
yes, that's a key. You still have to requalify for a 30-year loan after 6 months. And if you think the reason why you want to do it right now, okay, is because you know in 6 months you'll get a pay raise, and that will not that $250 will be a wash or whatever it is. But understand, every time you refi, there's a cost in it. So don't think that there's no cost in refi. And
Hmm.
typically that cost is rolling back into the loan. So I just want you guys to know that, you know, everything that you do does matter. And if 50 or if this product's even available, we're just talking about unicorn right now, but
Yeah.
there are whisper out there that says a
I mean,
50-year
I think
loan is
somebody is
coming.
going to come up with these. I mean, like any time that somebody can make money, they're gonna do it, and it won't be backed by Freddie or Fannie, but it is going to come into our marketplace, and you'll see some people talking about it and promoting it. And I think that there's one hand, yes, it can lower the payments on, but the reality of it is, I don't see this as being a win for consumers. I don't see it as being nothing I would recommend to my clients or my friends or my family because I don't think it's smart business.
And like I said, and we understand real estate appreciate that's a value of owning a home. Okay. And I get that all day. But once again, if you're not going to stay in the house for a long period of time, is this a good product for you? Probably not. You might as well do something else with just straight interest if you're not going to stay. So
All right. Well, good luck, everybody. If we can be of any kind of service, please call, text, smoke signals. If you have any questions about mortgage, hit this lady up.
thank y'all. Thank you for
Have a
watching,
great week.
and see you next week.
Yep.